Welcome, ladies and gentlemen, to another episode of Be the Bank. My name is Robert Hythe, the founder of FIXnotes and host of Be the Bank. It's my job every single episode to share with you everything that I know about the secondary mortgage market. Today's episode, we're talking about inflation versus mortgage notes and what you need to know as a real estate note investor getting into this business or already actively investing with regards to inflation and the prospects of the devaluation of the fiat currency in the near future. So before we get into it, I do want to thank the 81 members of the Mastermind membership group. Thank you so much for supporting FIXnotes and supporting your own businesses by joining the very best networking opportunity, the best resources, the best opportunities in the business through the Mastermind membership group. I do want to say hello to our little friend, David Rose, today. There he is. The one and the only David Rose, the Westie. He's getting bigger every single episode. Maybe he needs a haircut. He's a little fluffy. Now, I do want to say that we are very sad to not be sharing the bird watching with you today. There's a warning by the Audubon Society in the area that there's a songbird blight, and you're not supposed to be feeding them right now for risk of transmission. Sounds like something else. Sounds familiar. But we are not doing birds this week, but we are doing the koi. We've got the koi cam up and running. Hopefully it survives the duration of the show. There they are. A couple of little fish hanging out. So without further ado, let's jump right into it with the Be the Bank. All right, everybody. So we've got episode 35 for you today on July 28th. We'll first start the show talking about some free resources that FIXnotes offers to note investors. Then we'll talk overview of the industry. We'll talk about the tech that enables this industry to be run from anywhere you have an internet connection and a device. And then some asset acquisition opportunities coming up. Finally, some case studies. We'll be talking about a reperforming loan sale and also a non-performing loan payoff. And then finally, I'll share with you how to get on my calendar for a free consultation call. So let's jump right into it. I do want to share with you an event that's coming up. We actually have an in-person event coming up very soon here. And that is, oh wait, I want to share this with you first. So let's talk about what FIXnotes.com has to offer for you. So right off the bat, 100% free. Go to FIXnotes.com to learn how to invest in mortgage notes. We have an entire free online course. We've got our industry news aggregator so you can get up to date with what's going on in the business. And then we've got our limited mortgage note inventory. But if you want to unlock the complete mortgage note inventory for sale, private events and Zoom calls, our vendor database, forums and activities, case study details, county and state database, the document templates and calculators, the aggregated trade desk. This is all available to you through the Mortgage Note Mastermind. Go to FIXnotes.com/MNM. You can also consult with me, $360 per hour. We can talk about non-performing loans. We can talk about residential and mixed-use real estate. We can talk about leverage and creative financing, public speaking, live streaming, copywriting, freelance consulting, negotiation tactics, workflow process systems. There's so much that I can help you with in your business. By the way, I can do it for free. We'll talk about the free consultation calls at the end of this episode. By the way, if you would like to skip ahead to any part of the show, if you're watching not on the live stream, use the little scrubber at the bottom of your screen below my mouse over here, and you can click a chapter marker to jump ahead. But I do want to share this with you. This is a time-sensitive offer. Eventually, the Mastermind group will be $990 per month, but today it's $100 per month. We've got about 5 seats left at $100 per month. Now, we do increase the price by $10 for every 10 members. You can lock in your rate by joining today. Now, this rate will increase up to the point where we reach our cap of 1,000 members. So I do encourage you to check it out. There's a 30-day money-back guarantee. If you do want to join, I would highly suggest you do so, because if you don't like what you see, let me know and I'll send you a refund within 30 days. So there is a risk-free offer, but I know you'll love it. There's so much available in the group for you to maximize your business. And by the way, includes 50% off consulting. So my consulting rate is cut in half for Mastermind members to build that network. So definitely check it out. Now let's jump into the industry overview. So this week I do want to share with you an event. It's been a while since we've talked events, but this specific event is actually an in-person event. Do it this way. In St. Petersburg, Florida, September 30th to October 1st. Now, I do have a promo code for you. If you go to diversifiedmortgageexpo.com and use the promo code FIXnotes, I believe it is capitalized like that, you will unlock, I think, 10% off, maybe more than that. But I would caution you, with the COVID numbers increasing in Florida, it's going to be a little bit dicey. So definitely make sure you're vaccinated. I would wear a mask if I was there. I am not attending. I want to share some really exciting news with you guys. September is actually my wife and I's due date for our firstborn. So we are so excited to be bringing a little one into the family. A little one other than, oh, he's like shaking the cage. A little one other than David Rose. So unfortunately, I'm not going to make it. September 30th to October 1st. Definitely check it out if you're interested. I've been a speaker in the previous events, but this year it's just not going to be in the cards for us. All right, so let's get into it here with the mortgage note investment options. So as you know, this show, we talk about many different ways to get involved in the mortgage note industry. All the way from these passive opportunities like investing in a mortgage note fund through equity partnerships and partial acquisitions, and then buying your own cash flowing, reperforming loans, all the way up to buying and working out non-performing loans is the most active and the most involved way to get into notes. And I do want to focus on that. That is the main thing that we talk about on the show, because all roads lead here. If you are investing in a fund, the fund manager is doing this, so it's great to understand it. And if you are investing, listen to this guy. Here, let me, he's making a heck of a noise over there. We might have to send him away. I hope you can't hear him. Here, let me turn off the processing. You can hear him rattling around. There he is. What a little guy. Well, hopefully my noise gate cancels him out and I can stay focused on the show here. Buying and working out non-performing loans is really the focus of this show. And we'll start with the market pricing. So I haven't updated this slide for July because there hasn't been too many deals coming about in this last couple of months. But we do want to talk about the general pricing strategy with regards to seniors and junior liens. Senior liens we price either based on yield when they're performing, both reperforming juniors and reperforming seniors. We always price on yield. This is kind of like your cap rate in a residential or a commercial real estate deal. These are the expectations on the return. Oh, he escaped. He escaped his pen. Oh my gosh. All right, we're gonna just hope that he doesn't get into trouble and carry on here. So we price based on yield when we have some expectations of what's being paid on a performing loan. On the non-performing side, we price based on fair market value or unpaid principal balance. With regards to senior position liens, we price based on a discount to fair market value because seniors more often do resolve through the property versus juniors, which more often resolve through the borrower. So we do focus on the unpaid principal balance as the discount metric when we're calculating pricing on non-performing second liens. Now, these prices have been going up in recent memory. We actually did close one deal in the past 30 days in the non-performing junior sector, and that closed around 30%. So that's near the lower half, but right in the middle of that range. I'm gonna grab that boy. And maybe he'll hang out with us while we do the rest of the show here. Hey, David Rose. All right, so let's jump on to the waterfall evaluation, because this is really how we determine the market pricing when we're calculating individual assets for sale. So when we're looking at the waterfall evaluation, we start with the secured versus unsecured. That's the first thing on the list here, and secured versus unsecured is the biggest driver of price in this market because that's whether or not you have collateral securing your investment. So secured loans are really what we're looking for on this show. That's what we talk about here. If the loan is unsecured, we normally kick it out of the population or discount it significantly. But when it's secured, the next question is whether it's first versus second lien. Then we'll talk collateral value, bankruptcy, occupancy, all the way through title. Now, over the last couple episodes, we've been talking about all of these different statuses along the waterfall. We started with secured versus unsecured in episode 28, I believe. In episode 29, we talked about first versus second liens. In episode 30, we talked about collateral valuation methods and some really tactical ways that we use the recently sold comps method to do a manual review. Then we talked about bankruptcy overview. And then finally, some tactical there as well. And then the next episode was the occupancy triangulation. And then finally, last episode was about title report basics. So O&E is your ownership and encumbrance report. And we talked about how you can read a pro title report. We did some really hands-on work with the pro title lien report in our last episode. So now let's fast forward to today and talk about the next step in the waterfall evaluation. And that is the first lien status. Now we talked about title with regards to buying senior liens. We're talking about first status with regards to buying junior liens. This means understanding what's in front of you as a junior lien investor in the senior position. So let's jump right into that by talking about pay string status. Now, you can either have a senior lien that's current, semi-current, delinquent, foreclosure initiated, or all the way up through foreclosure collateral sold. And there's some important considerations to make there with regards to balance, past due amount, payment amount, and reported date. And then some other tidbits we're talking about the senior lien status when investing in junior liens. So right off the bat, we're actually going to look at a real credit report so that you guys can understand exactly what we're talking about. That hands-on, I think, is the best way to learn. But you're going to be seeing pay strings when we pull up the trade line in the credit report. And a pay string is essentially a string of numbers. 1 means current, 2 means 30 days late, 3 means 60 days late, 4 means 90, 5 means 120 plus, and if you see all 5s, it's probably foreclosure initiated. And what this essentially is saying is that the last 12 months, the borrower has been current. The last 6 months here, or maybe that's only 5 numbers, the borrower is 30 days late consistently or 60 days late consistency. Or here we have kind of a mix. Go back 12 months, they were current, 11 months still current, 10 months they got late by 30 days, but they paid the same month. And then they got all the way up to 60, 90, 120 plus days. And then foreclosure initiated would be in a remark. And we look at these 4 very important characteristics. The balance, of course, the past due amount to add to the balance to get the senior lien payoff amount, the payment amount to see how much the senior lien is paid every month by the borrower, and the reported date, super critical to make sure you're looking at current information. Some other credit report information we can see, and we'll jump right into that in a minute. FICO factors, occupancy status, employment details, public records, bankruptcy, lifestyle, and spending. So a whole bunch of information that we can gather from our credit report. So let's actually look at a real report here. And I'm going to just switch it while we say hi to David Rose. How are you doing, buddy? He's being really good. What a really good guy. All right, so let's jump over to the Instant Merge sample report. So this is actually a report done through CoreLogic CredCo. And this report is requested through 3 different credit bureaus, Experian, this is Equifax, Experian, and TransUnion. So we're actually getting a tri-merge report here, which is an important thing to consider because if you're only looking at one of these credit bureaus and you're not seeing the information that you'd expect, you may need to order a credit report from another bureau. But since we are looking at a tri-merge report, we've actually got all 3 at once. Now it's really up to you whether or not you'd like to order all 3 of these all together or if you'd start with just one or the other. I typically start with TransUnion, and then if I don't see the trade line I'm looking for with TransUnion, I'll order a tri-merge or I'll order a report from another vendor. But that's something that you can consider based on the pricing and your own workflow. So let's start at the top and see that this was ordered in 2006. Now we're looking at a sample with some annotations here for your own benefit, but this is an old sample clearly from 2006. But keep that date in mind because as we move through it, we'll use that as our baseline when we're looking at the reported dates for the other trade lines. As we scroll, we can see that we've got the 2 borrowers, Steve Insurance sample. We've got the current address, the previous address, and we hope that the current address is also the address on our data tape with the mortgage that we're reviewing, evidenced as the collateral securing the mortgage note. That would mean that this is owner occupied. Keep scrolling here and we can see a quick summary. We've got 2 real estate loans with a balance of $177,000 combined, a payment of $1,755. 1 loan is current, 1 loan is 30 days late. It's good we've got both options here so we can show you a delinquent mortgage. We've got installment loans. There's one of those for $8,985. That maybe is a car loan. A revolving loan, there's 3 of those, perhaps credit cards. A balance of $1,738, payments of $82. 2 are current, 1's closed. Other liens, maybe medical debt or something else there. And then we've got a total of 7 with a balance of $188,000. Now this is nice to see the summary, but this isn't really what we're looking for. We want to scroll down and actually see the trade lines. Take note of the FICO score, of course, 536. This is really going to be what determines the borrower's credit worthiness if they were going to get a refinance. And we can see some of the reasons why their score is pretty low. You know, this score can go up over 800. Most borrowers with delinquent loans are going to be somewhere in this 500 to 600 range. You can see that they do have some reasons why they are lower than 600. And we can see that there is a co-applicant and an applicant, both, we don't have the co-applicant provided, but the applicant, no match found. So that's interesting to see, and there will be some detail at the end of the report with regards to different socials and date of births perhaps being a mismatch. But the good news here is we have data. If you did not get any data at all, then you'd have more of an issue with regards to your particular applicant. Now, we skipped over this, but this is important to look at. There's an active duty alert present here. So there are specific laws with regards to an active military duty. So very important to understand that with regards to the Consumer Finance Protection Board and other considerations for active military. So let's scroll down here and get to the trade lines, because that's really what we're looking at. First thing we see is a joint account is for the borrower and the co-borrower. It's a countrywide home loan, home equity line of credit. So a home equity loan is generally in second position. This is a $40,000 balance originally. They pay $429 a month, and the current balance now is $37,906. You can see the status is current. That's great news. And it was reported in May. So that's okay, because you see that July was when this report was ordered, but this is 2 months late at this point. Now, this is not a red flag by any means. When I say check the reported date, the red flag is really if this was like a year or more out of date. And the fact that all of these ones means that they've been current, it looks like 24 ones. That's 2 years worth of payments being all current. So the odds of the June and July payment being made, well, the July payment would probably occur the day after the report. Oh, actually, sorry, this is not day, this is a year. But potentially the July payment would have come out sometime around the time this report was made. But generally, the trade lines are not reported by the credit bureaus until 30 days or so trailing. So it's nice to see it as a 6 or a 7 here, a June or a July, but by no means is this a red flag. This is a current home equity line of credit. Great news. Now, if we keep scrolling, we see an auto loan. This one has a balance originally of $12,764. It looks like maybe they borrowed $13,000 and maybe put down some money. Not really sure how that works for auto loans, but they paid $285 per month, and they owe a current balance now of $8,985. All current. Good news. Also reported last in May. So we're not seeing the complete picture, but it shouldn't be too much of a problem. Next, we see the Discover. They've got a Discover card. This is a credit card debt, a revolving line of credit. Let's keep scrolling. That's all current as well. That's good. And if we go to the next, we've got some derogatory items. So here's where we see the loans that are not current. And right off the bat, look at this, a Bank of America mortgage. So this is what we're looking for. As a junior lien investor, we were looking for the balance and the status of the senior lien. Now, how do we know this is a senior? That's the biggest question right off the bat. Well, primarily we know based on the date. This was originated in July of 2001, and this junior was originated in October of 2002. So this came second. That's the primary way to determine lien position, whether or not a loan was recorded before another loan. That would put you in senior position if you were recorded first. Now, the main caveat there is if a subordination agreement was recorded, these could be reversed, but in this case, it is not. The senior lien was recorded first. Another way you can tell is the higher balance. Not a cut and dried rule, but this is $147,286 versus the $40,000 junior. The senior is typically a higher balance loan. And then we've also got a reported status of June. So that's nice. We've got a more current data set here in this trade line. Now, let's see what we're looking at. It originated at 147. They pay $1,326 per month, and the current balance is $139,339. And they're delinquent. They're delinquent 30 days. There's a 2 here. That means that the last payment, they were 30 days late. The payment before that, they've been making payments, but they're 30 days late on their amortization schedule. But before that, 3 months ago, they were current for 4 months. They were late, they were current, they were late, they were late, they were current, they were current. All the way back to most, last year, they were 60 days late for a quick time, and then they got back to current. So this isn't bad at all. This was what I would call semi-current. What I don't see here is the past due amount. And that's such an important thing to calculate your total payoff balance. But in this case, for some reason, we are not seeing a past due amount. The good news, though, is because they're only 30 days late on this, the past due amount is probably just around 1 payment. Now, if this was much more delinquent, we would have a past due amount somewhere in the remarks, and that would be super important to check because the principal balance on a delinquent first lien doesn't hold the whole bearing. You really need to understand what the payoff amount is, including the past due balance. So not super bad here, and this is a pretty decent situation for the senior lien. Now, this is sort of unrealistic because this loan would not be for sale. A current HELOC like this with Countrywide, it hasn't been charged off. It's totally performing as agreed. This probably wouldn't have been a sold loan. So we probably wouldn't be in the situation where we're analyzing this first position lien. But for all intents and purposes, this is how you determine where this first lien is on the trade line credit report and then analyze these data points. Also interesting to note that they've been paying their second, they haven't been paying their first. So good thing as a junior lien investor to get your payment before they actually end up paying the senior. So let's keep scrolling here and see what else we've got. Chevron, this looks like maybe a gas credit card, Grant and Weber, some other type of credit card. Circuit City, that's another credit card that looks current. They were delinquent a little, but they're current again. We do have some public records. Now, this is where you'll see that there was a bankruptcy filed in 2002 and is discharged. Now, those reported dates that I talked about, they can sometimes be frozen in time when a borrower goes through bankruptcy. Then the credit bureau is not collecting data anymore from the lender, Bank of America, or the servicer of this loan, and it can be frozen. But since this loan was bankruptcy back in 2002 and it's been discharged, it's completed the bankruptcy process, that's a good news that the liens are still reporting. They're reporting again. So that's good. Let's keep scrolling here. We've got a GMAC non-applicant account. So this isn't a huge balance, but this would be something worth looking at title for if maybe GMAC had another lien, maybe a third lien on the property. But since it's a small balance, it's not super critical. It's not going to affect our equity position too bad. If we keep scrolling here, we can see name and social security variations. So it looks like these can sometimes occur due to applications to credit agencies or just mistakes in the credit bureau that aren't necessarily like fraudulent, but can be, maybe fat fingers when somebody was entering some data. In this case, though, they all look relatively the same. Oh, look, one's Stefan versus Steve. This social is actually different. Date of birth, that might be a totally different person, but they're giving you all the information here, which is good to see. There have been some inquiries. This means that maybe they were applying for some other credit or maybe an American Express card. So there were some inquiries made. And then we see the address information. They've been there since 2001. This was reported back in February, so not super current based on the July reporting date, but still good to see here. Some AKA information, looks like it's just them. And employment information, another really important point to see. One of them works for Berlin Tire, the other was the vice president for Acme Finance. The applicant is Steve, so Steve's at Berlin Tire, and his wife Sharon, she's the vice president of Acme Finance. So co-applicant and applicant, you can see that there. Keep scrolling. So these are some important points. Active duty alert, they're active military, an initial fraud alert, and some variation between the inquiry and on-file address. Now this isn't a major red flag because sometimes this variation can be as simple as a 5-digit versus a 9-digit zip code or maybe a small misspelling of the address. But it's an important thing to note. And this is something that I don't see very often, consumer statement. So this is a really, if you see this on a credit report, I think it's a really good thing because it gives you so much information here. Consumer has requested an alert be placed on their file because of active duty. There's also this fraud victim alert. Look, he tells us that he went to a delinquent status when he was out of the country. He's saying that there may be some fraudulent activity, and he's saying fraudulent application using someone else's information. My paycheck was delayed 6 weeks, and therefore I cannot pay the gas card. So this is something I don't think I've ever seen this before on a credit report, but it's good to know as a consumer if you owe money on a credit card or a mortgage. Even if you're current, it's nice that you can submit consumer statements to the credit bureau that can then be reflected on your credit report. Interesting stuff here. You won't see this that often though. Some decode directory, some other codes in detail, the fraud verification information, And let's keep scrolling here. Equifax, Experian, TransUnion. Oh, look, the TransUnion data didn't come through. So this is a really important point that I mentioned in the beginning. If I had ordered just a TransUnion and not a tri-merge, the TransUnion data wouldn't have had anything. So I would have to go back and order either a tri-merge or from one of the other bureaus to get this trade line information. Let's keep scrolling. This is the end of the instant merge report. And we've got just some trade line keys just to show you different details. And we already went through all of this, but interesting to see. Now, 7 is the past due. They've been past due 7 times 30 days, 2 times 60. I don't know why we didn't see the past due amount on that 30-day late loan, but you can definitely see it very clearly on most credit reports. So an important thing to consider when your senior lien is delinquent. All right, so let's get back over here. David's just been being such a nice, sweet dog today. He's totally hanging in there. And let's jump over to tech tips. All right. All right, so this business is so cool. The note business is so amazing because with the right hardware and software, you can run this business from anywhere. A capable PC or Mac, a decent smartphone, fast Wi-Fi or cellular connection, and then connecting all of these different software and web services, we are able to run this business from around the world. It's really quite amazing what's possible through technology today. Now, the hub really at the center of my business is Podio. Podio is a CRM like Salesforce or any number of different CRM solutions, but I like Podio the best as a combination of ease of use and power, especially power through Citrix Podio workflow automation, which used to be called Globoflow. And Globoflow allows you to connect to the various APIs across the internet or to connect within your own Podio operation to create automations and efficiencies that otherwise wouldn't be possible. Podio is especially awesome because I have a great iOS and iPad app that I can use to manage my portfolio, to see my contacts, to take notes in my CRM from anywhere, even if I don't have my laptop with me. I can also, based on the integrations that I've developed, mail out contracts to my loan buyers. I can generate payoff quotes. I can do all sorts of things just by clicking a button with these automated forms and templates that I wouldn't have been able to do if I didn't have my computer otherwise. Pacer, public access to court electronic records, is where we get our bankruptcy information, and I do have this connected into Podio for some automations of their own. Right signature is how we get documents executed for loan buyers. I typically don't use this for borrowers, but it is a great way to get loan sale agreements executed. Gmail has some great integrations as well and is such a critical hub for any online-based business. You're going to be sending emails. Zapier is a kind of a stopgap, sort of. Instead of using Citrix Podio workflow automation, you can use Zapier to connect various APIs without knowing any code. Really cool uses of Zapier out there, kind of to create your minimum viable solution and then eventually integrate that more hard-coded into Globoflow or Citrix Podio workflow automation. CoreLogic is a great resource for mortgage and property data, and actually that credit report we looked at was a CoreLogic Credco merge. But I would say this is more often used with bulk acquisitions. If you're doing one-off research, DataTree is the way to go. It includes a lot of the same information, although credit information isn't included there. You'd have to get that from TransUnion or another bureau that does tri-merge reports. Zillow is so great as a tool these days for reviewing recently sold comps and MLS status details and Zestimates, and you can also see rent estimates. A lot of great data there. Pro Title USA, we talked about in a previous episode for the ownership and encumbrance reports, title reports to review, especially for first liens. And then TLOXP was now recently purchased by TransUnion, is our skip trace provider of choice. Now, before you get to Podio or Salesforce or a CRM like that, I would recommend managing your inventory in Excel. Your Excel master inventory is a really great place to start understanding data management, keeping your data clean. It does have a downside of being, you have to scroll through column after column horizontally sometimes to review all of the aspects of your portfolio versus Podio, which I can see a single asset on a single screen, and I can also see it in that spreadsheet format. But I would recommend starting in Excel. You can use pivot tables to slice and dice your data. You can use formulas to keep things consistent. You can use things like drop drop-down fields and data validation so that you can make sure that all of your fields are consistent. So then when the time comes and your portfolio scales up to the point where you want to merge it into Podio, you've got a clean data source. So very important to consider, especially in a data-heavy environment, in a data-heavy business like real estate, and especially mortgage notes, keep your data clean. Google Sheets is another great option, especially for collaboration. So many awesome services today that are relatively affordable and allow us to scale up our note businesses all virtually. So really cool. All right, so let's jump over to asset opportunities. Actually, no, we've got our feature for today's episode, and that is inflation versus notes. Now, I don't have a whole lot to say about inflation versus notes, but I do have some important considerations that I want to talk about for note investors. And to start, let's just define what inflation is, at least in the context of this conversation. So inflation really just means the devaluation of our fiat currency. And the reason it's devaluing is because it is being printed to excess. There's been quantitative easing for years and years and years, and now it's like quantitative easing to infinity. And that's essentially just printing virtual money into the supply here. So as this fiat currency is printed to excess, everything is becoming more expensive, and our dollars are buying less. So it's actually interesting to see, just in my lifetime, over the last 31 years, since 1990, the buying power of a dollar has decreased almost half, maybe a little over 50% of the currency has been just devalued, evaporated. A dollar back in 1990 is worth like 50 cents now. Well, actually the opposite. A dollar back in 1990 is worth $2 now. And today's dollars are worth half of what they used to. Very, 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 even in, one lifespan here, and, hopefully I live a good while longer, we're seeing substantial rates of devaluation and of inflation. So in recent years, home prices have led the way with significant appreciation. And we're seeing that even into 2022, that housing is driving inflation. And a lot of that is based on the mortgage rates, which we're going to look at in just a minute here. But it's kind of crazy to see everything going up, with housing leading the way, single-family residential properties especially. So increasing property values provide more equity. So this is kind of good news that property, as real estate investors, that property prices are going up. Somewhat good news if you do have money already invested in real estate. But what's interesting is that over time, mortgage payments offer lenders less valuable dollars back. People are borrowing money today that's going to be worth less in the future. So as a note investor, you're on the wrong side of that equation. You're essentially buying discounted notes or lending money now that will be worth less when you get it back later. So that's no good. So what should a note investor do? What can we do about this situation to mitigate these intense market dynamics? Well, I think for starters, don't buy notes until you owe a mortgage of your own. I would not recommend buying a mortgage note that you're going to be paid back in less valuable dollars until you're on the other side and you have a loan that you are paying back with less valuable dollars. Now, it's definitely got to be long-term, low interest and fixed rate, because otherwise a variable rate could bite you in the butt later. But if you owe a mortgage today and that interest rate, and we'll look at that in just a minute here, and that interest rate is now under 3%, it's essentially free money when accounting inflation. If inflation is is more than 3%, then you're actually making money. You're borrowing dollars today that are going to be less valuable in the future when you pay them back. So I would highly, highly recommend as a real estate investor that you get on the right side of this equation here before you start buying loans, because then there are some ways, and we'll see that in the next slide here, to take advantage of this. But the best way to take advantage is actually to owe money. It's crazy because with inflation, savers are penalized, and spenders, especially spenders who rely on debt, are actually in an advantageous position. So it's sort of a perverse market dynamic that if you use it responsibly, you can take advantage of this dynamic in your own portfolio. So definitely lever up with inexpensive debt, low interest rate, long-term fixed rate mortgages to juice your portfolio returns as leverage, and also put you on the right side so you're paying back you're paying the bank back with less valuable dollars in the future. Now, it might be a single family home that you live in. It might be, your primary residence, or it might be a rental property. But in any case, you do want to owe a mortgage before you buy mortgages as a lender. That's my advice, at least. So let's say one more thing here. Buying discounted notes. So if your returns are significant, if your cash flowing or non-performing loans have a decent return, for reperforming loans around 10 to 20% cash on cash, and for non-performing notes as well, a significant internal rate of return when the loan is paid off, you will still outpace inflation for the most part. So a discounted loan, you're not in at par. So even if the face rate of the note is, maybe low, like 5%, which it's funny because that's low for a note investor, but in today's market, people are getting loans for much lower than that. You're still in a good position to have that kicker at the end because you bought at a discount. So at par value, you're going to be, breaking even maybe at 5%, but because you buy at a discount over time, you are getting paid back significantly more than the invested amount. So really important to understand those dynamics as you invest in loans, and do consider inflation in your models to determine whether or not you're exceeding inflation with returns. Now, the case studies that we've presented over the past 60 plus case studies now have all been significantly higher than inflation. We've seen our cash on cash returns of our reperforming loans around 15% or higher, and our internal rate of returns are often 200% or more. I think today's is around 100% internal rate of return. And because of the velocity that we're turning over these deals, you're not really hit hard by inflation if you close a deal within a year or two. It's really about buying and holding a loan for long term, like that 30-year chart that we looked at, where you're really going to experience the real effects of inflation. But by the way, most investors, because of that interest rate reductions over time, refinance their loans or sell the property and move to a different property within a couple of years. I think the average previously was about 7 years, and it may have extended in recent times. But you can't really expect that you'll get payments for the next 30 years as a lender. That borrower is most likely going to sell the home and pay you off, or refinance the home for a lower interest rate into the future. So kind of a non-issue in a way, because you'll be able to recapitalize and then reinvest in other opportunities sooner than the full term of your loan. All right, so let's jump over to the next slide here and talk about assets for sale. So we've got a couple of opportunities here. The next is probably going to be in late summer, or it's already late summer. So right now I'm thinking this trade is going to be coming maybe Q4 at this point. Non-performing second liens. Now we do have total access for our Mastermind members. Investors who sign our non-disclosure agreement on FIXnotes.com do not have access to all of the inventory for sale. The Mastermind members get to see product first from my direct clients, as well as from the entire marketplace through the aggregated trade desk. Now, when I put this presentation together, I think it was on Monday, we had already listed over 15.26 million of unpaid principal balance in 2021 alone. That's coming from market participants all over the space, listing non-performing and performing first and second residential loans for sale through our aggregated trade desk. We do put everything that comes through our email. I have my assistant post anybody else's assets that are coming through, and there's no charges here. We're basically just introducing you to other market intermediaries that you can work with to buy loans. Also, other members post loans on the trade desk that they have for sale, and I post loans from my clients as well. So if you really are looking for a product to buy, I would highly recommend checking out the Mastermind group for the most up-to-date, comprehensive list of what's available in the marketplace. And by the way, there's a 30-day money-back guarantee. If you join the Mastermind group and you're not satisfied, let me know before your first 30 days are up, and I will refund you. So there is no risk at all. And I forgot to mention when we were talking credit reports, I just posted in the last month, our meeting, actually the beginning of July, a 14-minute long credit report training video that I use for my assistants to teach them all of the different points that I pull out of a credit report when I'm analyzing one. So you can get that as well in the Mastermind group, essentially for free if you join, download it, and decide you're not interested in sticking around. So definitely check that out as well. We have so many amazing resources available in the Mastermind. Okay, let's talk about case studies. So our first case study today is a non-performing second loan secured by a single-family residential property that was resolved through a modification agreement. Reperforming loan value on this one was $30,000.33. So this is a great one because it represents the non-performing loan fix and flip, where we bought a non-performer, we got it worked out and paying again, and then we sold it to a reperforming loan investor. So there's always some major points to talk about first, and that's the numbers. First, the fair market value. In this case, the property, the single-family residential home, was worth $215,500. The senior lien was $86,195, which leaves us equity of $129,305, covering our $38,434 unpaid principal balance. That's awesome. Not only do we have coverage above the senior, but the borrower has coverage above both the first and the second lien. That means the CLTV is lower than 100%, which is great news. If we go to the next point here, we can talk about the three main considerations when we communicate with our borrowers. What happened? Where are you now? And what do you want to do? These are critical questions for non-performing loans because they allow us as a note investor to understand how we can help the borrower. That's really what this business is about. And with these answers, we're able to do so in a way that puts a solution together that's a win-win. So in this case, what happened? Well, there was an income reduction. The borrower wasn't being paid as much, and their loan was eventually charged off in 2018. The non-performing loan was sold in 2019. That's generally how non-performing loans get on the secondary market. They are charged off when the bank decides that it's not worth pursuing collections and they need to free up their capital constraints by writing them off, essentially charging off the loan and then reselling it a year later. So the non-performing loan was sold, and at this point now the borrower was previously 30 days late on the senior lien, but now they're caught up. They want to bring the junior lien current and were originally paying a little less than $400, but they can pay $400 a month now or more to start bringing that junior lien current. So we got a modification agreement in place at $442 per month with a $400 down payment and a $250 modification fee. So good news here is the borrower also intended on completing an ACH authorization. ACH is automatic clearinghouse, and that's a way to withdraw funds from their account automatically every month so they don't have to send in checks. You probably already pay some of your bills like that. I know I do. It's definitely the easiest way to automate your finances. So what do they want to do? Well, they want a fixed rate mod. We offered it at 8.75% interest and a 12-year term. So right off the bat, there's a strong incentive to refinance that loan. It's very unlikely that this loan is going to pay for 12 years. As soon as the borrower brings it current and has some track record here, most refinance companies want to see 2 years of current payments. Then this borrower could refinance and get 3% or less as an interest rate on a refi, which would pay off this loan. So it's most likely going to be paid off in the next 2 to 3 years as soon as this borrower is back on good standing. Now, this loan costs about $15,750, 41% of the unpaid principal balance. Now, it was actually a little less than 41% because the unpaid principal balance was slightly higher when it was purchased. This is the balance that was sold after seasoning. So we collected some monthly payments before it was sold as a reperforming loan. And after 9 months and a little over $1,200 of expenses, which covered due diligence and onboarding and collections and a mod fee, we reached a reperforming loan value, and we actually sold this one for $30,000.33. So some considerations to take away on this one. First of all, you can leverage a collection team. So a general kind of rough estimate in the marketplace is around $50 per month per asset, plus a success fee on the back end. We use a company called Singer Law Group, which you're welcome to reach out to and let them know I sent you. They charge, at least for the size of our portfolio, $50 per month per asset, and then a capped success fee. Now, some investors prefer a contingency fee model where maybe they're paying 20, 30% as a back-end success fee, but nothing for per asset fee. Now, it depends on your own business and how you want to structure it, but that's certainly a possibility as well. Another takeaway here is to hold your reperforming loans for 6+ months to maximize the market value for resale. That's what I mentioned, seasoning. You want to make sure that that borrower shows a consistent monthly payment before a note investor would take on that risk. Now, the seasoning required to refinance a loan is more like 2 years, but in the secondary market, most investors are looking for at least 6 months before they would buy the loan. Now, you can work with a reputable reperforming loan buyer for best execution for a quick trade, or you can market to an individual investor like an SDIRA or self-directed individualized retirement account investor for more profit. So it is a little bit more work to sell to a self-directed IRA. The custodian would need to sign a asset purchase directive. The custodian would need to sign the loan purchase sale agreement. The investor who owns the IRA would need to sign the asset purchase directive and also sign read and approved on the purchase sale agreement. And the assignment of mortgage needs to be recorded into the custodian's name. So there's a little bit more, wrinkle in that process, but you'll get much better pricing if you're not selling to a more institutional reperforming loan buyer and working with individual investors. So in this case, we sold to a reperforming loan buyer who was best execution, really easy to work with. We've closed many deals with before. And that's why the yield on this one was a little higher for this investor than it would be for an individual investor. So finally, faster exits and putting that money back to work equals a higher internal rate of return. Velocity is the name of the game. So if you're able to do a deal like this, maybe 2 every 3 years, or in this case it was 9 months, so just about that pace, then you're going to really increase your internal rate of return because you put your capital back to work. So let's look at the numbers. This cash on cash return for the reperforming loan buyer was just over 17%. So that means that if you spent $33 on a loan that was paying $442 per month after servicing expenses, you're looking at around 17% of your money back every single year. And since you're buying at a discount, you're also getting that kicker when the borrower refinances the loan. So your internal rate of return would be higher than that. The internal rate of return for the non-performing loan investor who fixed and flipped this deal is 121%. So that means that buying at $15,750 and selling at $30,033 in 9 months offered over 100% internal rate of return. And by the way, that does not include the $442 a month payments that were received over the 6 months of seasoning. So that's actually a lower estimate for the fix and flip exit. All right, so let's jump over to our next case study here. This one is another non-performing second secured by single family residential, but this one's a full payoff, an $87,350 payoff that we achieved on a deal that we didn't expect. This is sort of an interesting one. The fair market value is $582,200. When we bought it, we had no clue what was going on with the senior lien. So that means that the equity was unknown as well. Our balance owed was $87,350, but there was some red flags on this. And we'll see exactly what they were in just a minute. So what happened, where you now, and what you want to do? We're kind of taking a different angle on this one. This isn't really the borrower's perspective, but more the investors. So this loan was actually slated to be sold to a non-performing loan investor after my client purchased it in 2018. And it was part of a package deal that an investor was looking at acquiring. And before they funded it and before they, signed the docs, they actually pulled this one from the trade. They said, this doesn't fit our parameters, and we don't want to buy it. So they pulled it out. And years later, the borrower ends up selling the property, and the title company who worked the transaction finds the lien attached, and it needs to be released. So this was placed in the drawer by my client because there's a statute of limitations concern. They couldn't pursue the collection of the note because the personal liability was released in the statute of limitations. But when the title company looks on title, there's still a security instrument. There's a valid lien secured by this property that needed to be released. So they want to get it released because they want to sell the house. They want to have the new owner have clear title to it. So they want to send us the full payoff. So what do we want to do? Collect the full payoff. Now, there's no arrears on this deal because there weren't statements being sent over time. It would be incredibly disingenuous to pursue late fees and arrears on a loan that was kind of just sitting on the shelf here. There wasn't any evidence of the arrearage increasing. So what we did was just collect the full payoff through the title company and release the lien. That was a good one. We bought it for $12,250, 14% of the balance because of some of those unknown characteristics. When you reduce the uncertainty, you do maximize the value, but there was a lot of uncertainty in this trade from the start, especially with regards to that statute of limitations. It took 26 whole months, but very low expenses because this wasn't an active collection, to reach that payoff of $87,350. So a couple of takeaways for you here. Statute of limitations does apply to the personal liability, and you can't collect the promissory note when you have a statute flag like this. But the underlying lien recorded in the county record still needs to be released. The only way to clear title here is to release our lien that we've been recorded on title for. And that's the key here, is to record your assignment of mortgage. If you have your assignment recorded, you'll be notified of bankruptcies or other foreclosures or tax balances being sold, or the property being sold. The title company will find you on title and reach out to get the loan paid off. So even if a loan looks uncollectible based on the equity position or some other negative characteristic today, record your assignment so that you are on title so that you can be notified when the time comes to release your lien or to collect a payoff. So this was a big win and an exciting one because it wasn't totally expected. 283% internal rate of return. Even over 26 months, that IRR was well over 200%. So that was a really great payoff, which not typical, but a nice example of how some of these deals can be big wins, even when you don't expect it. So let's wrap up the show with the 15-minute consultation. If you want to subscribe, like, and comment on this video, we're aiming for 20 likes this time. So please, please, please like the video. If you can comment, it does help the YouTube algorithm very much. So definitely, I appreciate it immensely. And that would definitely be holding me to give you some consulting time. So get on my calendar at robbymax.youcanbook.me so that we can talk. We can talk about your business specific in real estate mortgage notes or really anything. We can get to know each other, see if you're a good fit for the mastermind group. So happy to get on calls, happy to meet some of our viewers here and try to, help me out with the subscribe, like, and comment. All right, let's talk about the upcoming schedule here. So our next event here is our mastermind call, which is coming up next week, first Wednesdays of the month. August 4th is our next mastermind call. And then we've got our next YouTube episode, Be the Bank, on August 25th. So definitely tune back in for YouTube for next month. And leave a comment if you have a suggestion on what you want to learn about. And if you want to join the mastermind before our August 4th call, you will not only get access to all of our previous episodes, all of our previous members only calls, but you'll also be able to join August 4th live and ask questions and meet our presenters that week, that month. So like I mentioned before, there's so much to offer through the mastermind group. I would highly recommend that you check it out so that you can see everything that we have, including, like I mentioned about the credit reports, a 14-minute training video on how to analyze credit reports so you can either train yourself or train your staff to help you with your due diligence process. And I have so much to share as a consultant. I'd be happy to, and you really get your money's worth if you're a member. So please join the mastermind or at least consider. We're actually at 81 members now as of today. You'll have access to the private Podio workspace so you can understand how Podio works in the context of all of these different resources that are available to you and your note business. And eventually it'll be over $10,000 a year to be a part of this group. So lock in your spot now. There's actually only 5 spots available at 100 per month, and then we'll increase to 110. So the price goes up, but you can lock it in today. And if you're watching this video in the future, sorry, the rate is no longer available, but the rate will keep going up until we reach our limit of 1,000. So do not hesitate, definitely join the group. And that is the Mortgage Note Mastermind, FIXnotes.com/MNM. And if you're already a member, go to podio.com/FIXnotes/mastermind to get back over to our portal. Awesome. So that's it for the Be the Bank episode. We had a really good one with David Rose hanging out with us today. He's always a cuddly guy like this. Well, sometimes he's naughty, but today's cuddly. So tune in next time for the industry overview, tech tips, vendor reviews, assets for sale, case studies, giveaways, and so much more. It's such a pleasure to present this to you every last Wednesday of the month. Let's see if the koi are still alive. I mean, I know they're alive, but the koi cam still has batteries. Awesome. Well, say goodbye to everybody. Little David Rose. He's such a sweetheart, isn't he? Bye, guys. Thanks for watching the show. Please like and subscribe. All right, let's watch the koi as we call it a day. Thanks for tuning in today, and please check out our socials. Leave me any comments below. That's probably the best way to reach me on the YouTube channel. And until next time, thanks everybody. Enjoy the month. Much success to you. And I'll see you then.